Thank you very much. It's now my pleasure to call upon Professor Paul Collier, our guest speaker, to speak.
Well, thank you very much for inviting me. It's just the sort of event that that Tanzania needs right now, I think. To indicate that it's a working session, I'm going to take my jacket off. And let me add, all protocol observed. Not only is it, do you know, my first time in Tanzania was in this hotel, in fact, in 1976. And let me say, the technology of the hotel has very considerably improved since 1976. As part of that, we're going to use some new technology today. You'll be very familiar with PowerPoint. So we're going to use PowerPoint I, which is PowerPoint Interactive, which is why we've got these screens here. And PowerPoint Interactive is a new technology in which, as I speak, you visualize what I'm saying on these screens, and then take notes. In other words, there's not going to be anything to look at. You're going to have to use your brains, right? And that's how it's going to be. Right? There's no substitute in the end for getting it in your head, right? And taking some notes. Right? And all these fancy technologies just distract from that. Now, what I've got to say, I must say I'm deeply sort of encouraged and impressed by the depth of the Prime Minister's presentation. But I'm also encouraged because what I'm going to say, although it overlaps with what you said, sir, it's not going to be the same by any means. And if it was the same, you wouldn't need me. Right? So I hope I'm going to be able to add value by... And the challenge is going to be fundamentally to how is Tanzania going to avoid this resource curse, which, sir, you quite rightly emphasize. And you also asked us not to be too detached from history. And if we look at the history of resource extraction in Africa, it's quite clear what that history is. And that history is a history of plunder. Now, plunder's a big emotive word, and I'm a little economist, so let me rein the word in and tell you plunder means two things in respect of natural resources. The one is that it means the few expropriate what should benefit the many. Sometimes the few are foreigners, sometimes the few are crooks within the country, but that's one form of plunder, the few expropriating a natural asset that belongs by right to all citizens. And that has been one major part of the history of resource extraction in Africa. Plunder by the few of the many. But the other form of plunder, which has also been rife across Africa, is plunder by the present generation of what should benefit the future. Because those natural resources, they're assets. They're only there in the ground. They've been bequeathed from the past. They don't just belong to this generation to burn up. They belong to all future citizens of Tanzania. And so the challenge is really to avoid these two forms of plunder. The few expropriating what should benefit the many, the present generation burning up what should build a sustainable future. So that's the challenge. And as I said, that is the history. Not universal history, but the most common history of resource extraction in Africa. And of course we should say that there's nothing distinctively African about the plunder of natural resources. We get within Africa some of the best managed resource extraction in the world. Look at Botswana. which for many years was not just the fastest growing country in Africa, but the fastest growing country in the world. Right? Turned itself from a dirt-poor, landlocked, semi-arid country to the richest country in Africa through well management of a depleting resource, diamonds. Or we look outside Africa, and there are plenty of examples of the resource curse. So there's nothing African about the resource curse, and there's nothing inevitable about it. Just let me add two little bits of information. I'm a professor of economics, so I do research, and researchers get excited about new discoveries. So let me bore you with a couple of my new discoveries on the resource curse. One is the effects of natural resource depletion on growth. And I and a colleague have looked recently at what is the short and long-term effects on economic growth rates of natural resource depletion, and especially of what happens if you either get new discoveries or higher prices. And the answer is that on average what happens is you get a phase of higher growth, but in the long term you end up poorer than if you hadn't had the boom at all. Now that is not inevitable. It turns out to be entirely dependent upon what you do. But the most common outcome is actually that these things make you worse off in the long term, which is consistent with this plunder of the future. You throw a party in the first few years, and then, like all parties, you bequeath a dreadful mess. Anybody who was familiar with Nigeria in the early 80s will recognize that. Right? Nobody throws a party like the Nigerians, not even the Tanzanians. Right? It was a wonderful party, and they've been paying for it ever since. So that's one little bit of research on growth rates, short and long-term growth rates. The other is very much more direct. It's on the effect of natural resource riches on the public capital stock. And since depleting natural resources is depleting a public asset, the most obvious thing that you should be doing is offsetting that depletion by building up some other public assets. So we might hope that the countries which were depleting a lot of natural assets, were fortunate enough to be able to deplete a lot of natural assets, would have atypically high public capital stocks relative to their incomes. And in fact, they have exactly the opposite. They have less public capital relative to their incomes than other countries. So what that tells us is something is going radically wrong normally in resource-rich countries. Public decisions seem to be going radically wrong. Now, the bulk of my talk is going to be on what are those public decisions? What is the chain of public decisions that has to be got right in order to harness natural resource depletion for sustained development? In order to understand what goes wrong, it's first necessary to just go through that chain of decisions and think, what has to go right? It's actually quite a long chain, so that will be the bulk of the talk, is going through that chain of decisions. But then finally, I'm going to pose the question, so normally this chain of decisions goes wrong. Here's the chain you've got to get right. What politically has to happen in order for that chain of decisions to be likely to go right? So that's going to be the structure of what we're going to say. And so now there's no alternative. We're going to roll our sleeves up and take the long march along that decision chain, harnessing natural resources for prosperity. And there's going to be 5 links in the chain. So using your PowerPoint interactive, you could write down number 1. Right? And number one, decision link number one is the process of discovery of natural resources. Discover your natural resources. And I'm going to start, this is in many ways the most important link in the whole decision chain. And to convince you of that, I'm going to give you one number, and I'm going to tease you in such a way that you'll actually remember it. Right? So this floor is conveniently arranged into giant squares. Right? So look at two squares and think one square is the typical square kilometer, or square mile, miles? Kilometers. It's a typical square kilometer of the rich world, the OECD. Right? And the other square kilometer is the typical square kilometer of Africa. Right? So this is the rich world, that's Africa, and it's the typical square kilometer. And we're going to peel the carpet back and look underneath the carpet to see what is the value of the natural resources underneath that carpet. Right? And first, we'll peel back the carpet for the rich world, the OECD. And underneath the typical square kilometer of the OECD is about $125,000 worth of subsoil assets, depletable natural assets. Right? That figure is as of the year 2000. Right? So $125,000 for the typical square kilometer in the rich world. And now we're going to go over to Africa. I can't because I'd lose the microphone, but we're going to peel back the carpet and look underneath that typical square kilometer of Africa. So $125,000 for the rich world, what is it for Africa? To make it more fun, you're going to tell me. And to make it manageable, I'm going to give you a simple choice. Right? But you're going to vote on it. That square kilometer of Africa, it could be less than $125,000, and it could be more than $125,000. Right? You're going to vote. Everybody who thinks that square kilometer of Africa is less than $125,000, raise your hands now. Everybody who thinks it's more than $125,000, raise your hands now. And this is why you're going to remember this, except for two of you, because you're all wrong. Right? You're not just wrong, you're very wrong. Right? The figure for Africa is about $23,000, right? About a fifth. Now, what is going on? Right? You all think of Africa quite rightly as resource rich, and yet what I've just told you is per square kilometer it seems to be resource poor. Now, I cheated. Right? Economists do sometimes do that. The figures I gave you were for known subsoil assets. You know, I tried to find the figures for unknown subsoil assets, and I just couldn't find them anywhere. Sorry, that was a joke, right? The only figures we know, of course, are the figures for natural resources being discovered. Right? What I've told you is not that Africa has less natural resources than the rich world. How could that possibly be? We've taken two huge chunks of land, about a quarter of the Earth's land surface each. Right? The geological processes underneath them happened hundreds of millions of years ago. Right? And taking two such large chunks, the averages are very likely to be more or less the same. Just think of the statistical process involved. Right? Two big random areas of the Earth, the averages will be more or less the same. Right? Except that Africa will probably be a bit higher because the OECD, the rich world, has been digging the stuff out for 200 years. And there's still $125,000 worth left there. Right? So Africa's going to be at $125,000 plus. Right? That $25,000, $23,000 was the figure for what's been found. The conclusion from what I've told you is that most of Africa's natural resources are still undiscovered. That's why managing the discovery process is going to be hugely important. In fact, you've learned two things. One, that the discovery process is very important. The other thing you've learned, if you think about it, is why has so much less been discovered in Africa than anywhere else? Because there's been less search. Why has there been less search? Because to date, the process of managing that search hasn't been well done in Africa. So there hasn't been enough search. Search is an investment. There hasn't been enough investment in prospecting. Now, it's just changing over the last decade. As I say, the figures I gave you were for 2000, the millennium. It's just changing precisely because the resource extraction companies know Africa's the last frontier on Earth for discoveries. So they're all coming here. But managing that discovery process, in financial terms, is probably going to be the single most important thing you do. If you multiply, suppose we take it from $23,000 to 125, you multiply by 5 what's been coming out of the ground. The effect's huge. So what do we know about managing the resource discovery process? Well, those of you who are economists, let me tell you, this is part of the economics of information, which has been a very active area of economics the last 30 or 40 years. We know that the market in information works very badly. This is not an area where free markets work well, because information is naturally a public good. There are huge externalities. It costs money to generate information, but once you've generated it, everybody can have it. So the market in information works badly. It's an area where you need government involvement. So that's before we think of discovery in particular. It's just generic about the economics of information. That's why governments around the world do so much investment in research and development. That's the economics of information. I'll just give you two little snippets here. One is that there's liable to be an asymmetry in information between resource extraction companies and the government. Resource extraction companies are specialized in particular resources. They're more likely to know what is under the ground than you are. Right? And it's a good idea to try and reduce that asymmetry of information. How do you reduce that asymmetry of information? You invest in public geological information. You need a public geological survey. You know, for years, the international agencies were discouraged by some of the big international resource extraction companies from doing that. And now the game is different. Last year, I'm an advisor to the World Bank, and last year the World Bank, I'm pleased to say, changed its position and said from now on we are willing to use IDA resources to fund public geological information. I should also share with you, I had an hour with the chief executive of the biggest mining extraction company in the world, and I put to him that governments should get public geological information before they came to the likes of him. And I thought there'd be some pushback. You know, leave it to us, we know we're the expert. What he said was this. He said, of course governments should get public geological information before they come to us. They'd get better deals. He's the guy who's sitting opposite the table from you. And even he thinks that. Right? So, invest in some public geological information. Then, what you do, you don't go all the way, you don't do the drilling, but you get the aerial information, aerial geological information. That's relatively cheap. as you do that, it reduces one of the big impediments to investment in prospecting, which is that resource extraction companies don't trust your promises. And it's no good getting indignant and huffy about this, they just don't. Right? There's a very simple reason why they don't, and it's known in economics as the time consistency problem. And let me sketch the time consistency problem in resource extraction by an example. Suppose that there's a prospect and you can sink a well, an oil well, and there's a 1 in 10 chance that you hit oil and you get $1 billion. Right? And a 9 in 10 chance that you get nothing. Right? And you as the government are selling that prospect, the 1 in 10 chance. And you put it up for auction. How much you're going to get, right? Anybody want to put in a bid? A 1 in 10 chance for $1 billion. Yeah? Any takers? Any takers? Huh? Yeah. You're going to cheat. A 1 in 10 chance of $1 billion is 100 million. Right? So the mathematical value of this thing should be $100 million. Why might a company not want to bid $100 million for this prospect? Because there are only two possible outcomes. You pay the rights, I buy the rights off the Prime Minister, here I am, Global Oil Limited, and I've bought the rights off the Prime Minister. And then there are two possible outcomes. I drill the hole, 9 in 10 chances, nothing. I've just wasted $100 million. Right? Nobody's going to come and say, very sorry, bad luck. I've just lost $100 million. Then there's a 1 in 10 chance. I'm now a billionaire. Right? And what do I fear that the Prime Minister will say? Or if the Prime Minister doesn't say it, that the Leader of the Opposition will say. Right? What I fear is the Prime Minister will say, you knew. You've paid $100 million for something that is worth $1 billion, and you did that because you cheated. You knew. And if he doesn't say that, think what the opposition is going to say, right? I dread to say, sir, what the opposition might say, but if you use your imagination, you might be able to conjure up an idea. Why did I manage to buy for 100 million something that's proved to be worth $1 billion, right? That's the time consistency problem, because who is that a problem for? Ultimately, sir, it's a problem for you. Because me in Global Oil, I can anticipate all that. I say, I'm not going to pay $100 million for this prospect. It's not worth it. Either I lose 100 million, or I get the contract torn up, or renegotiated in some way. So then I think, should I bid 50 million? But actually, that makes it even worse. You've only paid 50 million for $1 billion. Right? Sure to get it torn up then. In other words, these time consistency problems of low probability prospecting are pretty well insuperable. And that's one benefit from public geological information. You can get the odds better. You can say, well, here, actually, it's not 1 in 10, it's 1 in a million. And here, it's not 1 in 10, it's 1 in 2. And then if you just redo the numbers, you'll find that the extent of the time consistency problem is much less severe. So that's just an example of the economics of information and how to do that prospecting process. One other little suggestion. When you auction rights, don't auction a great area all at once. There are externalities from discoveries, and so you should creep along. Auction a few areas and then see what happens in those areas. If there are discoveries there, that increases the value of adjacent areas, and then you sell those later. So you creep with your auction. A final point, which is enormously important, big mistakes being made in West Africa on this one, is suppose you sell all the prospecting rights. What's the rational thing for a purchaser of those rights to do with them? I'll tell you, the rational thing is for them to sit on them in the hopes that somebody else will prospect the nearabouts, and they'll be able to learn whether it's worth them their own while sinking a hole or not. Right? And this is why if you leave it purely to the market, what you get is a long period in which people just don't do enough search. They buy the prospecting rights and they sit on them. Right? And then somebody strikes something, and then you get too much prospecting. You get what's called a gold rush. This is how America did it in the 19th century. It's a bad idea. Right? Too little prospecting for many years, and then all of a sudden too much. Right? Now, how do you correct for that? Well, you make sure that when you sell prospecting rights, the company buying them doesn't have the option of sitting on them for years. And so, together with the rights, has to come requirements that the company actually invests in search within a sensible period, say 3 years. And if they don't invest in search in that period, they lose the rights. I don't know, there's a country in West Africa I now advise where 17 years ago they sold off the rights and the companies are still sitting on them. And they sold off about half the damn country. So these are just instances of managing the discovery process, and why. And I've explained to you why that discovery process is hugely important, because there's so much money at stake. Now let's move to the next link in the chain. So on your interactive PowerPoint, right, number 2, and that is capturing the value of natural resources for the society. And here you need the concept, the economic concept of rents. Economists make a sharp distinction between profits and rents. Profits are a return on capital and risk and enterprise and all that sort of stuff. And rents are just pure value. The best way to understand the distinction is to think of a barrel of oil. You get a barrel of oil out of the ground today, and at the moment it's worth about $120. Right? The cost of extracting that oil, I think at the global average, is around $7. Now that $7 covers the cost of the workforce, the cost of the capital, the cost of the risk, returns to enterprise. So the difference between the $120 of the barrel of oil and the $7 that it costs to get out, the $113 is rent. Now who should get the rent? Nobody has earned it. That's the key point here. Rent is something that isn't earned. It's just intrinsic value. Now, clearly, the ethically, with natural resources, the right thing to say is these rents on natural resources belong to citizens. And the practical expression of that is that government, on the behalf of citizens, gets the rents. But the problem is it's the resource extraction companies which are taking the stuff out the ground, so the rents have to be got off the resource extraction companies. And that's the process of taxation in various shapes or forms. Now, the companies do not report rents. For the company, rents are indistinguishable from profits. They're all swept into the concept of profits. Profits for the company are just revenues minus costs. And so all the rents are just hidden inside the reported profits figure. So you need a separate tax regime for resource extraction than from, say, manufacturing. Manufacturing, there aren't any rents. There's just returns on capital, there's profits. And so you have normal profits taxes in manufacturing. But in resource extraction, you need special taxation. Taxes that get at the rents. Now, the taxation of rents is much more important in a poor country than in a resource-rich country. I mean, take Australia, or for that matter America, both resource-rich countries. And in Australia, you might remember last year there was a famous political struggle. I have to say, sir, it was a political struggle which cost the Australian Prime Minister his job, so I wouldn't recommend it. But he was trying to increase the taxation of natural resources in Australia, and there was a lot of political pushback from, guess what, the Australian mining companies. But what the Australian mining companies basically said was, why should the government have the rents? The rents on Australian natural resources are at the moment, they're accruing to Australian companies and Australian workers in the mining sector. And that view managed to get a certain amount of political traction. But of course it wouldn't be true here that the resource extraction companies in Tanzania are very largely not Tanzanian, they're foreign. In Australia, they're Australian. Right? And the skilled workforce that gets the high wages, in Australia, the skilled workforce is Australian. In Tanzania, the skilled workforce is often going to be foreign. And so, if you don't get the rents, you really don't get any benefits. If we just go down the east coast a little bit, down to Mozambique, a friend of mine is one of the world's specialists in resource taxation. And he'd just been in Mozambique. He just sent me a sad email about 3 days ago, which I'll share. It's all off the record, this, isn't it? It said the government of Mozambique has just given this resource extraction company a 50-year tax holiday. I wish I could have a 50-year tax. Anyway, it's a 50-year tax holiday. So his own calculations are that actually the resource extraction, this particular resource extraction in Mozambique, will be a net cost to Mozambique because it will get the environmental costs and no benefits. Right? Now, that example tells you not, first of all, that capturing the rents is really important, and secondly, there's powerful pressures at work that try and get you not to capture the rents. And after all, the example I've just given you is not a million miles away from Tanzania, it's right next door. Right? So, how do you capture these rents? You use some combination of three tax instruments, and frankly, you can only skin the cat once, and so if you use the more of one instrument you use, the less of the others you're using. The three instruments are a stake, a minority equity stake in the company, taxation of profits, and royalties. Now, the one that is most politically popular is a minority equity stake, because an equity stake gives you the sense of we still own the stuff. Right? There's a problem with it. And the brute truth is that anything you can do with a minority equity stake, you can do with a profits tax. But there is a lot that you can do with a profits tax that you can't do with a minority equity stake. So a profits tax is more powerful than a minority equity stake. The most, I talked with the Minister of Finance from Mongolia about a year ago. He said, I don't want to hear about minority equity stakes ever again. I've got them, and they're useless. And that's because the companies, having given the minority equity stake, then decide not to distribute a dividend. And if they don't pay a dividend, their minority equity holder doesn't get anything, right? At least with a profits tax, if they make profits, you can get them, right? Even if they don't distribute them. Right? Now, profits taxes are not magic, but they're that much better than minority equity stakes. Right? Why are profits taxes themselves not magic? Well, because profits are a figure that accountants construct as the difference between revenues and allowable costs. And surely you've got friends who are accountants. Sit down with them and have a talk with them about the range of discretion in allowable costs. A couple of years ago, I went to talk with the Revenue Authority of Zambia, and the job of the Revenue Authority of Zambia is fundamentally to tax the copper sector. And they disarmingly explained to me their problem. They said there aren't very many really skilled accountants in Zambia. All of them work for the copper companies. If the Zambia Tax Authority, Revenue Authority, finds itself with a really ace tax accountant, the copper companies come and bid them away. What is the job of the accountants working for the copper companies? Just think. Their job is to minimize taxable profits. Right? There's also all the companies that are resource extraction companies in Africa are subsidiaries of foreign companies. And they buy services from those foreign companies, they sell their output to those companies. And so there's an awful lot of scope for basically transferring profits from the subsidiary to the parent company. So a minority equity holder, you find, first of all, there's no dividends, the profits are transferred into the future, and then, whoops, they're transferred out of the country. I overstate the difficulties of a profits tax deliberately, right? Just to emphasize that profits taxes are part of the solution, but they're not straightforward. The basic principle of all tax is tax what you can observe. And correspondingly, if you're going to tax it, you better build a capacity to observe it. My friend Ngozi Okonjo-Iweala, the once and present finance minister of Nigeria, when she first became finance minister of Nigeria, she discovered that the oil companies had never actually been independently audited. They were sending each year a check to the Treasury for how much they thought taxes should be, but that figure was never checked. And so she brought international audit companies into Nigeria and said, audit the oil companies. The result was a check of about $300 million from the oil companies for underpayment of tax. Right? So you can't trust these companies. Right? It's not that they're dishonest, it's that over time practices build up in grey areas of accounting which inevitably are going to benefit them. Right? So much for that second link in the chain, taxation. Oh, I should say the advantage of royalties is that although they're a pretty dumb tax, because they're not taxing rents directly, they are taxing things which are relatively easy to observe. The sheer volume of resource extraction, the gross revenues, basically. So as a default option, royalties are not that bad an idea, I think.